Beyond inflation, the 5 overlooked catalysts. Driving gold's next bull run. While everyone fixates on inflation, insiders are quietly positioning for gold's biggest move in decades. These 5 hidden catalysts could send prices soaring before most investors even realize what's happening. Gold has already broken records in early 2025, but this is just the beginning. The real story goes far deeper than the inflation narrative dominating financial media. Today, I'm revealing the 5 explosive catalysts creating perfect storm conditions for gold's next historic bull run. Information that could transform your financial future if you act before the masses catch on. Catalyst number 1. Central bank accumulation frenzy. Central banks worldwide shattered all previous gold buying records in 2024, adding over 1,200 tons to their reserves. China alone increased holdings by 270 tons, while Russia's gold now exceeds 27% of total reserves. The latest Q1 2025 data reveals an even more dramatic acceleration. Smaller nations including Poland, Thailand, and Brazil have doubled their acquisition pace compared to 2024 averages. This unprecedented buying spree has removed substantial physical supply from global markets permanently. What's truly significant is the composition of these purchases. For the first time, central banks are paying premiums for immediate physical delivery rather than accepting future delivery contracts. This urgency signals serious concerns about systemic risks that aren't being discussed in mainstream financial circles. History demonstrates that periods of aggressive central bank accumulation have preceded average gold price increases of 40 to 150% within 36 months. With current buying intensity far exceeding historical precedents, we're witnessing early signals of what could become the most powerful bull market in gold's modern history. Catalyst number 2. The Great Currency Reset. The first quarter of 2025 marked the most significant shift in international currency dynamics since the 1971 Nixon shock. The expanded BRICS payment system now encompasses 14 nations representing over a third of global GDP, with 6 more countries, including Saudi Arabia, Argentina, and Indonesia, in advanced membership discussions. Saudi Arabia's non-dollar oil settlements reached 31% in March 2025, with the kingdom's finance minister explicitly stating their strategic pivot toward monetary diversification in February's landmark policy speech. Meanwhile, the UAE's recent implementation of gold-backed trade options with Asian partners signals a fundamental shift in petrodollar dynamics that's accelerating faster than analysts predicted just months ago. Most revealing is the April 2025 Bank for International Settlement survey, showing 62% of central banks actively reducing dollar exposure while increasing gold allocations. This represents a tectonic shift in reserve currency thinking at the highest levels of global finance, a multi-trillion-dollar reallocation event happening in slow motion. The newly established yuan-ruble-rupee settlement mechanism processed over $287 billion in Q1 2025 transactions, bypassing SWIFT entirely and exceeding total 2024 volume in just 3 months. Similarly, the Shanghai Gold Exchange's International Board reported 74% year-over-year growth in direct gold settlement transactions. Each incremental move away from dollar hegemony naturally elevates gold's monetary role within the international system. The accelerating pace of this transition creates structural demand that will persist regardless of short-term market fluctuations, providing unprecedented price support for years to come. Catalyst number 3. The gold supply cliff. Global gold production declined 3.7% year-over-year in Q1 2025, the third consecutive quarterly decrease, despite prices exceeding $2,600. Major miners including Newmont, Barrick, and Agnico Eagle have revised annual production guidance downward by 7 to 12% collectively. This production crisis stems from multiple converging factors. Average ore grades have plummeted to 0.8 grams per ton, down from 10 grams in the 1970s. Environmental regulations implemented across Peru and Indonesia in late 2024 have further constrained output from key producing regions. Most concerning for supply forecasts, New gold discoveries have plunged 72% over the past decade, despite record exploration budgets. With development timelines now stretching beyond 20 years, this discovery drought guarantees supply constraints will persist regardless of price incentives. Meanwhile, industrial gold demand for advanced semiconductor applications increased 18% in 2024 and continues rising in 2025. The combination of declining production, minimal discoveries, and expanding industrial use creates textbook conditions for a supply crunch that few investors recognize is already underway. Catalyst number 4. The paper gold unraveling. The gold derivatives market experienced unprecedented stress signals in early 2025. COMEX registered inventory reached historic lows of just 7.8 million ounces, relative to 43.2 million ounces of outstanding contracts, while physical delivery requests hit all-time highs for 3 consecutive months. Most telling is the dramatic 42% reduction in bullion bank short positions since mid-2024, a complete reversal of their decades-long suppression strategy. JP Morgan's precious metals desk, historically the largest short interest holder, reduced positions by 67% since December 2024. This positioning shift suggests serious concerns about their ability to source physical metal for settlement obligations. February 2025 marked a watershed moment when major Swiss refiners, including MKS, PAMP, and Valcombi, began offering substantial premiums of up to 9% for specific gold bar categories, indicating severe tightness in professional markets. This development passed largely unnoticed by retail investors, but represents a critical warning sign for the paper gold ecosystem. The spread between spot gold and immediate delivery has widened to unprecedented levels, with April 2025 seeing instances of $87 per ounce premiums for immediate physical settlement. Similarly, the once minute spread between London and Shanghai gold prices has expanded to a persistent $32 to $43 range, reflecting fundamental valuation disparities between Western paper markets and Eastern physical ones. With approximately 100 paper claims circulating for each ounce of deliverable gold, even a modest increase in physical delivery demand could overwhelm available inventories. The Bank of International Settlements warns that gold markets face unprecedented settlement risk in their latest stability report. When confidence in paper markets eventually falters, the premium for physical possession could explode virtually overnight. Catalyst number 5. The ownership revolution. Gold ownership demographics have transformed dramatically in 2025, with digital platforms reporting 127% user growth over the past year. Most significantly, 68% of new accounts belong to investors under 40, a complete reversal of gold's traditional demographic profile. In emerging markets, gold-backed payment applications surpassed 300 million users in Q1 2025, with transaction volumes increasing 83% year over year. This technological revolution has connected gold to vast populations previously excluded from traditional ownership channels. The April 2025 launch of instantaneous gold-to-currency conversion features across major payment platforms has eliminated friction in everyday gold utilization. This mainstream integration is driving unprecedented retail accumulation through millions of small, consistent purchases. This accessibility revolution represents perhaps the most underappreciated catalyst, creating persistent bid support from hundreds of millions of new market participants. This new demand pattern is entirely different from the cyclical investment flows that traditionally dominated gold markets. The perfect storm convergence. While each catalyst alone would support higher gold prices, their simultaneous convergence creates exponentially stronger market momentum. This explains gold's remarkable resilience in early 2025, despite conditions that traditionally would pressure prices: elevated interest rates, dollar strength, and stabilizing inflation. The latest trading patterns reveal smart money positioning ahead of broader recognition. Managed money long positions in gold futures increased 34% in Q1 2025, while ultra-high net worth allocation recommendations from private banks now suggest 12 to 15% portfolio exposure, triple their historical averages. These positioning shifts typically precede major price movements as institutional awareness grows. The current setup mirrors early 2001 conditions before gold's 650% decade-long rise, but with substantially stronger fundamental catalysts across every key metric. If you were here for the full analysis, you'd understand why the gold market stands at its most critical inflection point in modern history, and exactly how to position yourself before these catalysts fully register in market pricing. Are you prepared to capitalize on what could be gold's greatest bull market before mainstream investors flood in? Have you positioned your portfolio to benefit from these five converging catalysts? The window for optimal positioning narrows each day as these forces gain momentum. Subscribe now for our complete 2025 Gold Strategy Guide and leave a comment sharing which catalyst you think will have the biggest impact. If this analysis opened your eyes to what's really happening in gold markets, wouldn't you want to share it with someone who needs this information before it's too late?